Here are 3 ways you can buy high-value UK property tax efficiently. First one is use a mortgage. Any asset that's situated in the UK is subject to be considered for inheritance tax, regardless of where you live. One way of mitigating this with property is to actually use a mortgage. This way, only the equity portion is considered as part of your estate for inheritance tax purposes, which makes a huge difference when you're looking at high-valued properties. The second method is to use life insurance. So whilst it might not be possible to avoid taxes, there's definitely lots of ways you can prepare for them. One of these is buying a term life insurance policy to cover the mortgage. So if anything was to happen, the mortgage is paid off, or using life insurance to cover any potential inheritance tax liability on a property or just in general. And step number 3, so this really only applies if you're buying an investment property, is to hold the property in a company structure. There are many benefits to doing this. Namely, you pay corporation tax instead of income tax, which will benefit higher rate taxpayers significantly. You're able to gift shares of the property to beneficiaries over time, rather than your beneficiary having to inherit a whole property asset all at once if it was held in personal name, which again mitigates inheritance tax. And finally, if you do hold a property inside a limited company and it also has a mortgage, you're able to fully offset the interest costs against your UK income tax bill at the end of the tax year, whereas you're only able to do this partially if you own the property in personal name. So for investors, from a tax point of view, it could be worth considering owning the property inside a company. None of this should be considered personal advice, but if you have any questions around how to best structure buying UK property, get in touch.